One of the questions I hear early on from most business owners is, how much am I going to pay in taxes when I sell my business? This is a fair question, but the problem is most owners ask it too late. By the time they get around to this question, which is usually after an LOI is already signed, some of the best planning moves are already off the table. And what I've noticed after years around founder-led businesses is that owners tend to focus on the sale price. They want to know what the company is worth, what multiple they might get, who the buyers are, and what kind of offer is realistic. These are all fair questions. But here's another number that is worth just as much attention. What do you actually keep? Because the same business sold at the same price can leave two different owners with two very different after-tax outcomes. I have seen two owners sell for roughly the same valuation and one walk away with significantly more wealth than the other. He didn't negotiate a better price or find a better buyer. He simply started planning earlier. The tax bill attached to a business sale isn't a fixed number. It is shaped by decisions made well before the sale ever happens. That's where a lot of owners get caught off guard. Hi, I'm Ryan Guth. I work with business owners thinking through major liquidity events, and one thing I spend a lot of time helping people understand is that the transaction itself is only one part of the equation. Structure, timing, tax planning, estate planning, and personal planning shape the outcome just as much as the sale price does. So in this video, I'm going to walk you through what actually drives your tax bill when you sell, and why so many owners leave money on the table simply because they started thinking about this too late. And if you're already wondering how this applies to your own business, I've included a link in the description where you can schedule a free consultation, no pitch, just a quick conversation about your specific situation. Okay, let's start with the biggest lever, the structure of the deal. Many owners that I speak with are surprised to learn that not every dollar from a business sale gets taxed the same way. The biggest driver of that is whether the transaction is structured as an asset sale or a stock sale. Generally speaking, buyers tend to prefer asset deals. Sellers tend to do better in stock deals. Now, that's a simplification and every transaction is different, but buyers often like asset deals because they can pick up certain tax benefits and avoid inheriting certain liabilities. Sellers often prefer stock deals because more of the proceeds may qualify for favorable capital gains treatment. The point isn't that one is always better than the other. The point is that it's negotiable. Many owners assume the structure is just handed to them. In reality, it's often one of the biggest conversations happening during the deal process. And if nobody's evaluating the tax implications alongside the legal and financial ones, it's easy to leave money on the table. Okay, next up is entity type. A C corporation can produce a very different tax bill than an S corporation or an LLC. C corp owners run the risk of double taxation, the same dollar getting taxed once at the corporate level and again on the shareholder level. Pass-through entities like S corps or LLCs generally avoid that. Entity structure shapes the outcome, and changing entity structures, if it's appropriate, usually takes years of lead time, not weeks. This is why timing plays such a big role. A lot of owners think tax planning starts when they receive a letter of intent, but in reality, that's often when a lot of planning opportunities start disappearing. Next, there's the proceeds themselves. This is something else that surprises owners. Not all of the sale price gets taxed the same way. Some may qualify for capital gains treatment, some gets taxed as ordinary income. There's also something called depreciation recapture. These are deductions that you took over the years, coming back at the sale, often taxed at higher ordinary rates than the rest of the gain. Owners sometimes estimate their tax bill off of the headline capital gains rate, but then find the real number looks a lot different. There's also purchase price allocation. This one rarely comes up outside deal circles, but it can shape what an owner actually keeps. Buyers and sellers often want different things when it comes to how the price gets allocated across asset classes. And that allocation drives the tax treatment of the proceeds. So the conversation isn't just about the total purchase price, it's about how the deal is built underneath it. Then there are additional layers. You've got federal capital gains taxes, the 3.8% net investment income tax, thanks Obama, which stacks on top of your capital gains rather than replacing it. And depending on your situation, there may be state taxes owed in places you didn't expect. For example, I work with some owners in Tennessee where there's no state income tax, but that doesn't automatically mean a seller owes nothing at the state level. If the business operates in another state and has a, quote, tax nexus in that state, the state can still come looking for its share. So for example, I have an office, clients, and employees in New Mexico, so I pay gross receipts tax on my New Mexico income. So for me and a lot of businesses, the good outweighs the bad. What I'm getting at is that generic tax estimates can be misleading. Every business has its own quirks from a tax point of view. If you're starting to realize how many of these variables are still within your control, that's exactly the kind of thing worth talking about before the deal is already in motion. So there's a link in the description where you can schedule a free call. No pressure, just a quick conversation about where you stand. Okay, now I'm going to give you a handful of planning strategies that may be worth knowing about depending on your situation. First, installment sales can spread the gain across multiple years, which can soften the bracket impact instead of taking a full hit all in one year. Then there are charitable strategies that use charitable remainder trusts or donor advised funds. These can work well for owners who know their number and also have philanthropic goals in mind. Pre-sale trust and giving strategies can move some of that gain into lower or no tax positions, but they need real runway to work, which is another reason why early planning pays off. And for a narrower group of owners, there may be benefits available through qualified small business stock under Section 1202. So the rules around QSBS actually expanded in 2025. So qualifying owners can now see tiered exclusions starting at a 3-year hold, a per issuer cap that moved up to 15 million and a gross asset ceiling that increased to 75 million. But this only applies to qualifying C Corp stock, and eligibility comes down to specifics that are worth checking out with your team. The point is the details shape the outcome, and so does the timing, and so does planning. Which brings me back to my original question. How much will you pay in taxes when you sell your business? The honest answer is it depends. It depends on the deal structure, your entity type, your state, your basis, your planning, and how early you start. The biggest mistake isn't paying taxes. Taxes are part of a good outcome. The biggest mistake is assuming the number is fixed when most of the variables are actually still in your control. That's why I think owners should start these conversations years before they think they'll need to, with an advisor like myself, a CPA, and an attorney coordinating together instead of working in separate silos. The best planning happens now. So if your business is generating $1 million or more in annual profit, and you've started thinking about what an eventual exit might look like, it's time to start asking these questions. Not when the LOI shows up, please no. Not when due diligence begins, also please no. And not when everyone's working against a deadline. Also, no, don't do that. Now, do it now, because the real goal isn't to just sell your business. The real goal is what's on the other side of the exit, what you actually keep, and how that supports the life you are trying to build for you and your family. So if you'd like help thinking through any of this, click the link in the description where you can schedule a free call now. There's no pressure, no obligation, just a chance to look at the moving pieces while they're still easy to move. Thank you for watching, and I will see you in the next one.